You do the research, map the support levels, and enter the trade, only for the market to chop sideways until your stop loss is triggered. A few hours later, the currency pair makes the exact move you predicted. Many traders exhaust their energy predicting where the market is going, while ignoring the volume of gas left in the tank. Entering a position during a flat, chopping market leads directly into the sideways trap. These environments drain accounts through a slow series of false defaults out instant reversals. Standard trading tools usually act like a compass, pointing up or down. Surviving a sideways market requires a speedometer to measure the intensity of the move itself. Success depends on your ability to quantify the market's raw power before putting capital at risk. To measure that momentum, we use the Average Directional Index, or ADX. This indicator strips away price direction to isolate and measure pure trend strength. This chart shows the ADX as a single line oscillating on a scale from 0 to 100. When this line rises, the current trend is gaining power, regardless of whether the market is bullish or bearish. The bottom quarter of this scale represents a sleeping market. In this range, price action is erratic, and the most profitable decision is often to stay on the sidelines. A trend is officially born when the ADX line breaks upward past the 25 threshold. This awakening confirms there is finally enough market participation to support a sustained move. However, relying on this single measurement has a catch. Because the ADX calculates current momentum, sudden, short-term price spikes can trick the indicator into printing a false reading. While it successfully isolates momentum from direction, trading off that raw data alone leaves a position exposed to market noise. You need a secondary layer of defense. That defense is the Average Directional Index Rating, or ADXR. This is a smoothed, lagging sibling to the ADX, designed to filter out short-term, erratic jumps. Here we see that second, smoother ADXR line overlaid onto the primary ADX scale. Comparing the two allows you to identify if the trend's momentum is actively accelerating or beginning to decay. During the acceleration phase, the erratic ADX line crosses up and over the smoothed ADXR line, signaling a strengthening trend. This provides a go-no-go entry rule. If a separate indicator gives a buy signal, the trade is only valid if the ADX is above 25 and positioned above the ADXR. Combining the raw intensity of the ADX with the stability of the ADXR provides a binary logic gate for reading subjective chart patterns. All market momentum eventually burns out. Identifying that decline is just as critical as finding an entry point. This dual-panel chart shows price action on top, momentum indicators below. During decay, the ADX drops below the ADXR, signaling a consolidation period to tighten stop losses. The ultimate red flag is divergence. Price continues hitting new highs, while the ADX line falls. Falling momentum despite rising prices indicates that volume is drying up. Institutional smart money is often quietly exiting their positions, even as the price continues to climb. Applying these indicators moves you away from gambling on direction and toward riding proven waves of momentum. Utilizing this crossover approach prioritizes the discipline of staying out of flat markets over the urge to catch every minor price fluctuation. Open your charts today, apply the ADX and ADXR indicators to your historical data, and backtest them to see how many false breakouts you could have avoided this month.